Peter Schiff, CEO of Euro Pacific Capital, thinks so. He joins us now. So, Peter, overall, I understand there are risks with the economy, the oil patch, et cetera, but overall, don't the benefits of cheaper oil outweigh the negatives?
Well, long term, of course, and it's always a good thing. You know, contrary to what the central bankers and the economists are telling us, it's always a good thing when consumer prices fall. You know, even Janet Yellen acknowledged the benefit of lower gas prices. Well, the same thing applies to all prices. But here's the problem, David. If it turns out that we had a bubble in the energy sector, I mean, if the Fed really does raise interest rates, and I don't really think that they're going to,
right,
but if they do, and the oil price stays at these levels or goes lower, our previous guest just mentioned maybe $40, all of the activity in the oil sector for the past several years is going to turn out to have been a bubble. And the layoffs that we're going to get in the short run and the credit losses and the CapEx spending declines will be significant enough in the short run to push the U.S. economy back into recession. I mean, I think it's a bigger impact than the bursting of the dot-com bubble, and that brought us into recession back in 2001.
Right. Well, you mentioned that the dot-com bubble was primarily a stock phenomenon. There weren't a lot of these dot-com companies that had a lot of debt, unlike the oil patch. A lot of the oil companies and gas companies have gone into debt. They've issued a lot of debt in order to drill for their wells.
And they've also hired a lot of people. You know, most of the good jobs that have been created over the past few years were created in that sector. And so these jobs are now at risk. And I think this is somewhere between the dot-com bubble and the housing bubble. I think it's bigger than dot-com, smaller than housing. But again, there were positive effects of falling home prices because it made it cheaper for people to buy houses. But there was a lot of debt that was accumulated and a lot of layoffs in the sector. So we're looking at the same possibilities in the oil sector. But here's a bigger question to ponder. If it turns out that oil was just a bubble created by cheap money, well, what about the stock market? What about the housing market? What about the bond market? What if they're all bubbles? What if the oil bubble is just the first of many bubbles that are going to pop?
Well,
we have much bigger problems there.
We could do the what ifs for a long time, but you question whether oil prices are all supply and demand. And I just want to put up a figure here. OPEC just came out with a new forecast for 2015. They produce 30.5 million barrels a day. That's more than 1.6 million barrels than they sell. In other words, there's a surplus every day of 1.6 million barrels. Isn't that why there's a glut of oil on the market?
Well, I think the bigger problem is where is the global demand? I think if the demand is contracting, it's because economies are slowing down. And I think this is going to include the United States.
But hold on a second. Hold on. They are producing more oil. I just gave you the 3.5 million barrels per day that they are now producing. That's more oil than they used to produce, despite the fact that there may be a cut in demand.
No, but demand is not growing as fast as it should be. Given the nature of I think the global economy, I don't think there's been that significant an increase.
But my point, Peter, is they are trying to drive down demand. They're trying to drive it down to hurt oil fracking in the United States. They're trying to hurt the Russians who are moving in on their territory with China. There are a lot of reasons. They were also trying to get the Iranians. Why the Saudis are producing more oil than was needed. They wanted to drive down the price.
Well, I mean, perhaps. But, you know, in the short run, they certainly are affected substantially because they derive a lot of revenue from oil. But, you know, if they have some kind of plan to try to drive down production abroad so that they can ramp the price back up and have less competition, you'd have to take that conversation up with the Saudis. But one of the countries that's certainly going to be impacted, and that's my point, is the United States. Look, if I were bullish, if I thought we had a legitimate recovery, which I do not, I would still have to be worried about that recovery being derailed by a collapse in the oil sector because that has been the brightest spot in the U.S. economy. And if we extinguish that light, what is going to take its place? Where are we going to get the high-paying jobs to replace the jobs that we're losing in the oil sector?
Now, some people say that the fracking technology has improved so much they could still make money even if oil did go down to $40 a barrel, which I don't think the Saudis have the stomach for.
David. They can't. I mean, there are some wells that have been drilled that will be able to be sustained at that price. But there is going to be no new drilling, no new CapEx, at that price. And I've been involved in the fracking industry myself. I've got a lot of my own money. I have client money invested in North Dakota. We're in Texas. And I can tell you that.
Whoops. Well, he could tell us a lot of things, but unfortunately, we need a satellite for him to do that, and we lost the satellite. Peter Schiff, Euro Pacific Capital. We thank Peter for joining us. We want to hear from you. Could the negative